Now let's start with chapter 1 of the textbook. And chapter 1 covers deterministic models. We're not going to do any simulation in this chapter, but it sets up a couple of models that we will expand in the next chapters by adding um, simulation features for the uncertain variables. So in this chapter, we're going to uh, look at how the model is set up in a deterministic environment. And the two examples that we're going to discuss are movie pass and retirement planning. And then we'll also talk about how to set up or best practices when setting up models in Excel and how to avoid pitfalls and errors, and if there are errors in the model, how to uh, look for those errors with features available in Excel. Okay, so let's get started with the first case, which is the MoviePass case. MoviePass was a company. So here is some information about MoviePass in Wikipedia. It's a defunct company. It filed for bankruptcy in January of 2020, and the business model is to sell subscriptions and to customers, and the customers will then be able to um, go to movies, okay, X number of movies. So initially, I think it was like 2 or 3 movies per month, um, and if you paid full price for those movies, it will be much more than your monthly subscription. At one point, they offered one movie per day, so that was a lot of incentive, and that resulted in heavy increase in subscriptions to the company. And then, long story short, they couldn't manage the cash flow problems, and then they ended up with bankruptcy. Okay, so you can read more about the background of the company here, but let me lay out the outline of the case that we will be looking at and modeling in Excel. And here we're going to look at uh, the time when the company offered one movie admission per day um, for a flat monthly subscription rate of $9.95. Then the cost of one admission to be paid to movie theaters at that time was $8.97. And of course, one of the things that the company was hoping to do is to negotiate with movie chains to to get some discounts on that. But for our purposes, let's assume that it is $8.97. And in the next chapter, we will analyze what will happen if they are successful in those negotiations. But right now, for the purpose of this chapter, let's assume that it's $8.97. So in that case, well, uh, then the overall movie attendance rate for the US population at that time in 2017 was 0.77 movies per person per month. So the idea is that at that rate, um, so you will have only, if that rate continues even after the subscription, then for the company, the monthly cost will be $8.97 times on the average 0.77 movies, and then you subtract that from 995, then you get a gross operating profit of $3.04. Of course, there is a major flaw in this assumption is that once a customer purchases a subscription, then the rate of movie going is not going to stay at the average rate for the entire United States. It's going to be higher, and also people who right now go to movies at a higher rate um, will probably be the ones who will subscribe to the service. So we'll look at all those issues in a little bit. So the if at the average movie going rate, the profit, the gross profit margin per subscription is $3.04. So profits depend critically on how frequently subscribers go to theaters, of course. The actual movie going rate is uncertain. It's going to increase once they subscribe. Um, and at this point, the financial position of MoviePass company seems extraordinarily shaky. Okay, so that's the overall background. Okay, the factors that affect profitability. Okay, decision variable is the price of the subscription. You can increase the price from $9.95 to whatever amount. Okay, and you can negotiate cost of admissions. Okay, now we can run what if analysis with the model for these two variables. You can set decision variable value at different levels and then the negotiated variable at different levels and see what will be the outcome of the of profit. And also there are a couple of other factors that affect profitability, and those are uncertain variables. Rate of subscription. So how many subscriptions will we get? Okay, and after somebody subscribes, what will be the increase in the movie going rate of that person? Okay, so from 0.77 movies, how much is it going to increase? And also we may want to segment the population. Instead of using an overall average of 0.77, we can segment the market into different levels of current movie going rate, and in each of those segments the probability of subscription would be high. If currently people are the segment where the current movie going rate is like 2 or 3, they are definitely going to subscribe. Very high probability of subscription. On the other hand, if the current movie going rate is like 0.5 or 0.1, then the subscription rate of subscription is going to be low in that segment. So we have to look at this segment by segment, and even within each of those segments, once a person purchases a subscription, that person, if they had been going to movies at a rate of say 0.5, they're probably going to increase that rate to maybe 1 to make the subscription worthwhile. So we have to deal with those situations when we set up the model. Now, the factors that affect the rate of subscription, of course, is the current movie going rate, and 0.77 is the average. Okay, and the second factor that will definitely affect is the break-even movie going rate. At this point, the subscription price is $9.95 and the cost of admission is $8.97. So that gives us, if an average person goes to on the average goes to 1.1 movie per month. So this should be movie per month. Okay. So if a person goes 1.1 movie per month, 1.1 movies per month, then that's the break-even point. At that point, if you continue without subscription or if you buy subscription, you will be even. Okay, but if your movie going rate is more than 1.1, then you will be financially better off, and if it is less than 1.1, then subscription is not for you. But of course, if you buy for those who go to movies at a smaller rate than 1.1, after purchasing subscription, they may increase their rate to greater than 1.1. In that case, it will make sense. Okay. Now, framework for analysis is segment the market. in the current movie going rate, and for each segment we have to determine the probability of that customer of a customer buying subscription. Okay, because that's going to vary depending upon the current movie going rate of that segment. And then we will, based on that, we'll figure out how many subscriptions there will be. That will give us the revenue per month, okay, number of subscriptions times subscription price. And then we have to model cost, which will be how many movies in each of those segments they will actually see. So number of movies seen in each segment times the cost per admission, which is $8.97 at this point. And then your operating profit will be revenue minus cost. And of course, we need to take into account the amount of increase in movie going rate per month after buying subscription. So this is the general outline. And one major issue here is to accurately model the probability of subscription in each segment. So that will be our next topic.